What is going on with the markets? We are now in correction territory. Is this the start of the next Great Depression? Are we just seeing the early signs of where this is going to go? Is it because of these Russia and Ukraine tensions? Is it because of inflation? Is it the government printing unnecessary money? What are the reasons? Is it the Fed minutes? How much money have you lost in your portfolios? I haven't lost anything, so we're going to talk about that. But this is another episode of What Now? What's Next? And I'm your host, Chris Naugle, so let's get right into this. So as of today, we are officially in correction territory, which means by definition, the markets are 10% off of their highs. And that is a telltale sign, but that's not the only part of the sign, because here's what scares me is everybody right now is saying, oh, buy the dip and just keep buying low. Folks, do you want to buy the dip and lose all your money? Because if it goes, it's going a long way down. How far down? Well, by the numbers, about 50+%. So you want to buy the dip today at about 10 when you're going to lose another 40%? I don't think so. So be careful who you listen to and who you take your advice from, and also be careful in what you do next. Now, here's the thing. Some of the telltale signs of the beginning of this. We've all known that we've been in a bull market for far too long. And my fear is a lot of the people watching this right now have seen nothing but bull markets. They've never even seen a bear market. They've never seen a recession. They've never lived through the dot-com crash like I have. They were not a financial advisor through 2008, the Great Recession. They don't even know what that means. They just think everything's going to the moon. And I got news for you. It's not.
Houston, we have a problem.
Now, I don't care what you invest in. You might be an S&P 500 investor. You might be like, oh, Chris, I invest in technology. It'll be fine. Amazon's not going anywhere. Netflix isn't going anywhere. Oh, Netflix just dropped a huge amount. Oh, Tesla, those cars are going to be around forever. That company's not going to drop. Already did. Oh, I'm in pharmaceuticals. You just lost money. Listen, do you understand how the tide works in the ocean? If you're sitting there watching the tide go out, what happens to the boats? They all sink. And when the tide's coming up, what happens to the boats? They all go up. That's exactly what you have to look at. The markets as a whole will go down. And, oh, I'm in crypto. I'm okay. I own Bitcoin. How's that been looking for you? Because all of them are going to go correction zone, because everything's correlated and everything will fall as this correction continues on. And folks, it's probably going to. But let me explain this a little bit better for you. You see, the markets work in very predictable and rhythmic cycles. There's a short-term debt cycle, which most of you have probably seen. Short-term debt cycles are about 5 to 8 years. You can actually push it to 10 years because of the stupid monetary policy the government uses. But then there's the long-term debt cycle, which is the most important one. And the only way to really see how that cycle works is to go all the way back to about 1929. Now, do any of you know what happened in 1929?
Anyone? The Great Depression.
So if we really take that moment right there and we take when the Fed started printing money to curb the Great Depression, how far have we come from that point? 75 years. 75 years is the key indicator for the long-term debt cycle. It's a 75 to 100-year cycle. Now, some people say, well, it's going to keep pushing. Well, maybe you're right, because the worst thing you can possibly do is try to time the market, like buy the dip. That is timing the market. You're never going to get it right, ever. Even the best in the world, the Ray Dalios, can't get that right. Not only are we at the end of a 75-year long-term debt cycle, that one you need to pay attention to, we are way past the end of a short-term debt cycle. We are at the end of the capital cycle, and we are also at the end of the technology cycle. So do you really want to play Russian roulette with the end of all those cycles? And do you want to think that we're going to rewrite history and not do the same things that have happened all the way back to the 1500s? Heck, you can go back even further, but I've got it back to the 1500s. The writing's been on the wall. You ever hear the song, signs, signs, everywhere signs? That should resonate with you right now, because that is what you need to prepare for. You need to prepare for this long winter season, if you will, happening. And how do you do that? Well, you better be careful with what you're investing in. You better be careful who you're taking advice from, and you better be investing in things that you know, like, and understand, or investing with people that are experts in their field through time, knowledge, wisdom, and make sure that they've failed. Make sure that they've gone through a period like we're entering. Make sure that they've seen a recession and know what to do and how to do it, because that is going to be the only thing that's going to allow you to prepare for what's next. So what are these signs? Let's really look at them very closely. Well, first off, since 2008, what has the government been really good at doing? Printing money. Modern monetary theory, if you follow that, the government has printed money, creating debt. Because how the printing works is not to get into the weeds, but there is the federal government and the central banks. Most people think the Fed and the government are the same. They are not. They are completely separate.
Say that again.
The US government borrows the money from the Fed. And how do they do that? Well, they issue debt, commonly called treasury bonds. And what does the Fed do for the federal government? They give them money to the tune of, what is it? I don't know. Nobody really even knows how much money they printed. Is it $5 trillion during this COVID pandemic? That's about right. They print $5 trillion. And the Fed cannot give money to you. They can't give money to me. They can't buy things from the citizens of this country. The Fed can only invest that money in the capital markets. And how do they do that? By buying bonds, of course, by buying IOUs. To date, they have about $9.8 trillion, I should do it like this,
$9.8 trillion
worth of debt, consisting of US government debt, which is treasuries, T-bills, and also mortgage-backed securities. So when they buy all these bonds in the open markets, which I've already heard, that's what they've been doing. Stimulate the market, stimulate the economy by buying and investing in these bonds. All they're doing is they're just trading money for debt with the US government. And the US government does what? Spends the money. They gave it to you. How much did you get? About $4,000. They give it to businesses, PPP loans, EDIL loans. They distribute the money into the economy, giving everybody a false sense of reality. And then the government, what else do? They set policies. They change policies. They put things in place so that the economy starts getting back on track, because nobody could go to work during the COVID. So all of a sudden now, the government pumps all this printed money, the money that just came out of thin air. They give that to its citizens because they exchange debt. That debt goes into the capital markets, making the Wall Street bubble do what? You ever see a hockey stick? That's right, it's a hockey stick. Take a look at this chart. That shows you the hockey stick. Not only that, real estate. What is the other thing the Fed did when the markets were tanking because of COVID? Didn't they pull the interest rate lever? Down to zero, they pulled it. That's right. And they were even talking about going negative, but they didn't. When they drop interest rates to zero, what does it make all of you want to do? What did it make me want to do? Let's go buy some shit. That's right. Let's buy some cars, because getting the loan is cheap. Oh my God, let's refinance our house. Let's buy some more real estate. The real estate investors go, woo! We're going to go buy some more real estate. Why? Because money's cheap. And it stimulates what? Bubbles. Bubbles in real estate. What has the price of your house done? Has it gone up? Has it gone sideways? Or has it gone down? You know the answer. Real estate's all gone up across the country. I live in Buffalo, New York, the place where nobody even wants to live. It's about 0 degrees out with 36 inches of snow that has fallen in the last week. Do you want to live here? No. So why is our real estate going up? Because all real estate is going up, because when you make it cheap to get money, you drive up demand. When you drive up demand, supply suffers, and there isn't enough supply, meaning, oh yeah, you learned this in economics. Oh, you didn't pay attention in school? Well, start paying attention now. The supply and demand is created because of actions the government took. Oh, you just ordered a new computer, but you got to wait 6 weeks. That video game console that you just got that you thought you were going to get for Christmas, well, that should be arriving in the next 2, 3, or 5, months, or is it weeks? That's right. All the ships out in the harbor that can't come in. Supply and demand issues. Driving price where? Up. Money's cheap. The supply is low. The demand is high. The bubble keeps getting bigger and bigger and bigger and bigger, and then you end the cycle. Take some notes here, folks. This is the most important thing I can tell you. You see, as my income goes up and your income goes up, because everybody's gotten a raise, right? It's hard to get, it's hard to go out there and not find a job paying you quite a bit of money. Hell, I just saw that McDonald's is hiring fry cooks at $18 an hour. And I heard that I think Apple is giving hundreds of thousands of dollars in bonuses just to get employees to stay. That means incomes go up. Your income goes up. And when your income goes up, what do? You spend money. When you spend money, you create somebody else's income. If I spend money with your company, let's just say I make 100 grand and I spend 100 grand with your company, your income is now 100 grand. But then you see, we layer credit in there because everything is going good. Banks want to give you credit because your income just went up. So now you got $100,000 income and the bank says, we'll give you credit of $10,000. So what is your income now? $110,000. So how much can you spend? $110,000. So your spending is somebody else's income. So now somebody else has the ability to now spend 110. And we keep doing that over and over and over. And that's how the economy grows. And it's stimulated by the government printing money. It just makes it grow faster and faster, which is exactly what you've seen since the beginning of COVID. But that's not the beginning. This is exactly what you saw in the 1930s after the Great Depression. It's what you saw in the 70s. It's what you saw in the 80s. It's what you saw in the early 2000s. It's what you saw after 2008. You see, this isn't new. This is how the economic machine has always worked. You just did not pay attention in economics class. But when everything goes up, where must it go? Back down. Welcome to reality. It's got to go down. The cycles are ending. The government and the Fed just came out with their Fed minutes. How many of you read the Fed minutes? Pay attention here. What did the Fed minutes say they were going to do? They're going to raise interest rates. We are at historically low interest rates. How many times did they say they were going to raise rates? 2? Nope. 3? Yep. 4? Maybe. Hey, maybe it'll be 6. 4 to 6 times they're going to raise interest rates this year in 2022. If they raise interest rates, what does that start to do to the economy? Slows it down because inflation's out of control, over 7%. We got to slow the inflation down, but it's a delicate balance because as you raise rates, you make it harder for people to borrow money. As people's borrowing starts to slow down, their incomes will also start to slow down because you have less credit. So everything will start to slow down and cool off as rates go up. But the government has to raise rates to curb this nasty hyperinflation that's starting to form. But if they raise rates too fast and too much, you will stall the economy like stalling a plane midair. Do you guys want to be in an airplane and all of a sudden you just give her just a little too much and poof, hey, honey, the engine just stopped. How would that feel when you're 30,000 feet up and you just hear that silence? Well, that can happen too. If the engine dies, we're going down, folks. And the engine is running on fumes right now.
Brace for impact.
But let's go to another sign. See, in the Fed minutes hid a little thing that not many people understand or even paid attention to. You see, the Fed said, we're going to begin to taper the bond purchases. In other words, the Fed's going to slow down the printing press, not buy as many bonds from the U.S. government, which I already explained. And then in doing that, they also said one thing that is a true killer of any economic or capital markets. Here's what it is. We are going to begin the process of unwinding the balance sheet. What does unwinding look like? Well, we've been buying all these bonds to the tune of about $9.7 to $9.8 trillion worth, and we're going to start selling some of those things because we want to unwind our balance sheet. Just like if you owned a company and you had a bunch of debts and you wanted to start to unwind them, you'd start selling things. And who would you sell them to? The open markets, okay? So that's what the Fed will do. They will start selling these securities, bonds, printed and issued by the U.S. government, or these mortgage-backed securities, how those work out in 2007, 8, 9, 10, all that. Yeah, great, right? So they're going to start selling those in the open market. I want you to take and visualize the movie Spaceballs. You see, there was a part in Spaceballs where the bad guys pulled up to this planet, it was Earth, and the spaceship converted into a maid. And the maid had a vacuum cleaner, and she put the vacuum cleaner on Earth, and she turned it on. And you remember, it sucked all the oxygen out, and they were going to deplete all the oxygen of this planet we know as Earth. Picture that sight and that visual. Because when the Fed starts selling bonds in the open market, it will literally be that vacuum cleaner sucking liquidity out of the open markets. And all I need to tell you is that is the beginning of the end for what you know and what you see today. Signs, signs, everywhere, signs. Are you paying attention? So now that I've scared the living daylights out of you, now I want to give you some tips, some simple, actionable tips on what you should be doing today. Well, number one, stop buying into FOMO. Stop buying into the fear of missing out on some gain and start realizing it's not about what you actually make. It's not about the riches you've made during this bull market. It's about what you actually get to keep. So at this point, you should now look at your risk tolerance and say, does the risk outweigh the reward or does the reward outweigh the risk? Right now, all I'm going to tell you, I'm going to give you the answer. The risk is too much. So dial back the risk. Your portfolio, wherever you're invested, look at it. Where are your gains? Warren Buffett said it best. How you make money in the markets is buy low, sell high, and don't lose money. Where are we now? We're high. And some people are like, yeah, but Chris, it's down 10%. I just lost money. Do you want to lose more? Buy low, sell high, and don't lose money. You cannot time the market. You will get it wrong every single time. So cut back on the risk. Slow down your risk, reallocate your portfolio, take the winners off the table and position them in safer assets. What are those safer assets? Well, if you're asking me, and I know you're gonna laugh, but US Treasury bonds, that's right, 20 and 30-year US Treasury bonds, or find an ETF that holds and buys 20 and 30-year US Treasury bonds. Why? Because when the Fed does the next drop of interest rates, right now they're raising them, and when they raise the interest rates, the price of the bonds goes down. It's an inverse relationship. Then when the markets keep crashing, the Fed will pull that interest rate lever, click, 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 ching. And then when they pull the interest rate lever, rates now went down, the price of the bonds go up. Do you want to buy low? Yes, well, that is how you buy low. You buy the assets that are going down. And then when rates are pulled to zero, where do the price of the bonds go? Up. And where do you sell? High. Now I just gave you the formula for that. Cryptocurrency and any investments. You see, when you look at this entire market, if you look at this chart right here, that's an overall look, taking back all the way to 2008. This is where we're at right now. Does that look like a big drop in the grand scheme of things? No, it's a little blip. You wouldn't even notice that, would you? But right now it feels pretty bad because you're in the moment. You're looking at this through a microscope. Step back and look at this from a macro standpoint, from a holistic standpoint. This isn't a big deal. So what you should do is stay the course. Keep investing, but do it on dollar cost averaging. Put a little bit in every week. Put a little bit in every month. Find a diversified mix of investments or asset classes. I don't like diversifying just in stocks, bonds, mutual funds, and ETFs. I like diversifying across asset classes. So find the ones you know, like, and understand, and then put a little bit of money in on a systematic basis. It's called dollar cost averaging. So as this sucker keeps going down, what do you want to do? Buy, and buy, but you don't want to buy all at one time. You want to slowly do it. You're never going to get it right. You're never going to hit the top and you're never going to hit the bottom. So just dollar cost average. Your crypto. Well, I'll tell you what I'm doing. I've been buying. Everybody's freaking out. Crypto's dropped to, I don't know what, 50, 60, 70%, depending on where you bought it. Great. That's an opportunity. Listen, folks, I want you to understand. Here's the biggest tip I'll give you. What is about to happen and what is happening in the Bitcoin and Ethereum and the crypto space presents an unusual opportunity. Because if you could have gone back to 2009 and 10 and bought, where would you be today? I'll tell you, pretty darn well off. But you got to start doing it now. You got to buy when everybody else is scared to buy. As Warren Buffett says, when others are greedy, be fearful. I've been fearful for a while. You probably haven't because you've been buying into FOMO. But now let's switch it. People are starting to get scared. And as it goes further and further down, they'll get more and more fearful. When people are fearful, you need to get greedy. Warren Buffett isn't a dumb guy. Why don't you just watch the news? When he starts buying, maybe then you can start putting chunks of money in. Until then, just dollar cost average in. Because in the grand scheme of things, like I showed you from the chart, this isn't anything other than an opportunity if you're positioned and ready for it. But don't let fear get the best of you. I hope this helped. Enjoy it and catch us for the next episode of What Now? What's Next? And if you like this content, there's way more. Make sure you click that subscribe button. Don't worry, I'll wait. Yeah, just click it. It's not hard. Just go down right there. It's somewhere on your screen. Click the subscribe button. And then also while you're at it, why don't you smash that little bell up top, that alerts button, so we notify you every time we got a new video, so you know what to do, when to do it, and you know what's now and what's next. We'll see you on the next episode.